At this very second, Direct Digital Holdings, ticker symbol DRCT, is trading at 12 cents, specifically $0.1247, showing a push to the upside of over 7.9% in today's intraday session. While the broader markets are fixated on the massive liquidity flows into mega-cap tech, this micro-cap stock is quietly battling for its existence in a trading zone that most institutional algorithms automatically filter out. You are looking at a market capitalization that has compressed to roughly $3.5 million, a valuation that effectively prices the company as an option on its own survival. The volume today is already swelling past the average, indicating that despite the depressed price, traders on platforms like Robinhood and SoFi are stepping in, speculating on a dead cat bounce or perhaps something more structural. When you see a stock trading at 12 cents with this kind of percentage volatility, it is no longer just an investment. It is a high-stakes probability scenario playing out in real time. The expectation from the general market, and certainly from the risk management desks at major firms like Fidelity or Interactive Brokers, is that Direct Digital Holdings is in a terminal decline. The prevailing narrative suggests that the company, having lost a massive chunk of its revenue due to an external suspension and a so-called disinformation campaign, is simply waiting for the inevitable delisting from the Nasdaq. Most investors scanning their Schwab Intelligent portfolios would look at the 90% year-over-year drop and assume the story is over. They see a company that has received delisting notices, a company with a going concern warning from their auditors, and they assume the equity is destined for zero. That is the expectation, a quiet disappearance into the over-the-counter markets. However, the reality is far more complex and decidedly more aggressive. What we are witnessing is not just a failing business, but a company that is frantically restructuring its entire cost base while sitting on one of the most unique assets in the programmatic advertising space, Colossus SSP. The reality that challenges the bearish thesis is the sheer leverage embedded in this 12-cent price. If the company survives, just simply survives, and stabilizes its cash burn, the repricing event would not be measured in percentages, but in multiples. The market has priced in bankruptcy with near certainty. Therefore, any news that is not bankruptcy, any announcement of a new credit facility, a strategic partnership, or a resolution to their suspended ad inventory, creates a volatility event that could rip the stock upward violently. This is the tension. The market expects death, but the company is cutting costs by 25% and growing its buy-side revenue, creating a disconnect that speculative capital is starting to notice. To understand why the stock is moving today, we have to look at the mechanics of what they actually do. Direct Digital Holdings operates in the ad tech sector, specifically through a supply-side platform, or SSP. In the split second it takes for a web page to load, an auction happens. Advertisers bid for the space on your screen. Direct Digital subsidiary Colossus SSP is the technology that helps publishers, the websites you visit, sell that space to the highest bidder. But Colossus is not just another generic platform. It is the only minority-owned SSP on the public market. This distinction is critical because major Fortune 500 companies have mandates to direct a percentage of their advertising spend toward diverse media. For years, Colossus was the primary pipe for that capital. The reason the stock collapsed from its highs of over $10 down to 12 cents is largely due to a single catastrophic event. A major demand partner suspended them. The company alleges this was a result of a targeted attack on their reputation. This cut off the oxygen to their revenue engine, causing the sell-side revenue to plummet by over 80% in recent quarters. When you look at the chart today, that 7.9% move to the upside is likely a technical reaction to the extreme oversold conditions. The stock has been hammered relentlessly, and at 12 cents, selling exhaustion sets in. Sellers who wanted out have largely already sold. You are left with a mix of trapped holders and aggressive accumulation by high-risk accounts. If you are trading this on a Robinhood stock trading account or through SoFi Invest, you are likely seeing the bid-ask spread widen. This is characteristic of micro-cap liquidity. In Interactive Brokers, where you might see more sophisticated order flow, the depth of book shows a wall of resistance at 15 cents. If the price can reclaim that level, it triggers a different psychological phase for the stock. Comment below how many shares of direct digital holdings you currently hold, or if you are staying away entirely. Are you betting on a recovery or playing the volatility? Let's analyze the financials that were released for the third quarter of 2025, which are driving the current sentiment. Revenue came in at roughly $8 million. To put that in perspective, in the same quarter of the previous year, they were doing significantly more business before the crisis hit. The sell-side revenue, the money they make from Colossus SSP, dropped to just $600,000 in the quarter. That is a staggering decline. However, and this is the contrarian angle, their buy-side business, Orange 142, actually grew revenue by 7% to $7.3 million. This means the company is not dead. One half of the heart is still beating strongly. Orange 142 focuses on helping mid-market brands spend their advertising budget efficiently. It is a service business, less scalable than the tech platform, but it is generating cash. The market is ignoring the stability because the tech platform's collapse is so loud, but for a value investor willing to stomach extreme risk, this bifurcation is interesting. The company has also been aggressive with cost controls. They reduced operating expenses by 15% in the third quarter and 20% year-to-date. This is the survival mode I mentioned earlier. Management is slashing payroll, optimizing server costs, and doing everything possible to reduce the cash burn. They are trying to land the plane on a very short runway. They reported a net loss of $5 million for the quarter. While that sounds bad, it's an improvement over the $6.4 million loss in the prior year. They are losing less money, even with lower revenue. This suggests that if they can turn the revenue tap back on even slightly, the bottom line could improve rapidly. We must also discuss the macro environment for ad tech in late 2025. The advertising market is shifting away from third-party cookies, a change that Google and Apple have been pushing for years. This makes first-party data that publishers own directly, extremely valuable. Colossus SSP, because it works directly with thousands of small and mid-sized publishers, theoretically has access to this valuable inventory. The industry trend is moving towards supply path optimization, where advertisers want to cut out the middlemen and go direct to the exchange. Direct Digital Holdings launched Colossus Connections to capitalize on this initiative, aiming to link directly with demand-side platforms. If this initiative gains traction, it could bypass the intermediaries that blocked them previously. This is the strategic pivot that could save them. However, we cannot ignore the elephant in the room, the Nasdaq listing requirements. The stock is trading well below the $1 minimum bid price. They have received deficiency notices. Typically, companies in this position have two choices: a reverse split or delisting. A reverse split, say exchanging one share for every 20 you own, would bring the price back up to $2 or $3, satisfying the exchange but often signaling weakness to the market. Retail investors on Robinhood view reverse splits negatively, leading to a further sell-off. The alternative is moving to the OTC markets or pink sheets, where liquidity dries up and many Fidelity ETFs and Fidelity mutual funds are forbidden from holding the stock. This institutional exodus is what has kept the pressure on the price. The influence of retail trading platforms cannot be overstated here. A stock priced at 12 cents is accessible to anyone with a smartphone and a SoFi account. It becomes a favored target for momentum traders who organize on social media. We have seen this phenomenon before with other distressed names. If a narrative takes hold, perhaps the idea that the disinformation campaign was unfair and the company is an underdog fighting back, the retail army can flood the order book. Unlike Apple stock or Tesla stock, where it takes billions of dollars to move the needle, a few $100,000 of inflow into DRCT can send it up 50 or 60% in a single session. This creates a dangerous but enticing environment for day traders. But let's look deeper at the institutional side. Who is left? There are still some quantitative funds and index providers holding shares, likely purely for tracking purposes, but the active managers have largely departed. This leaves the float, the number of shares available for trading, highly sensitive to news. Any positive press release, perhaps announcing a new partnership with a major agency or a legal victory regarding their reputation, hits a vacuum of sellers. The short interest is another factor. If traders are shorting the stock at 12 cents expecting it to go to zero, they are taking on infinite risk for a maximum gain of 12 cents. This is a crowded trade. A short squeeze on a penny stock is violent because the cost to cover becomes exponential relative to the entry price. The broader ad tech sector is currently valuing companies at roughly 3 to 4 times revenue. Direct Digital Holdings is trading at a fraction of that, largely because the market doesn't believe the revenue is sustainable. But if we look at the buy-side revenue alone, $7 million a quarter or $28 million annualized, and apply a conservative service business multiple of just 0.5, the buy-side business alone could be worth more than the current entire market cap of $3.5 million. This suggests that the market is assigning a negative value to the SSP business, assuming the liabilities and cash burn outweigh the asset value. This is the definition of a deep value distress play. For those using Schwab Intelligent Portfolios or seeking investment help, this is the kind of stock that is usually red flagged.